Hello, I'm Tony Kay. I'm the editor of Eureka Report, and we're talking with Bruce Brammall, our superannuation editor, about the incoming changes to superannuation coming into effect on July 1, 2017. So Bruce, one of the first questions is, how can I maximise my superannuation before the new changes come into effect?
Carl, we're working with two sets of limits at the moment, Tony. Of course, we've got the current rules which apply until June 30 and those that apply after June 30. Now, prior to June 30, we have the existing concessional contribution limits, which are $30,000 for the under 50s and $35,000 for the over 50s. So if you're able to make the most of those contribution levels, limits, then probably a good idea to do so. Perhaps that might include salary sacrificing some extra prior to June 30. Post July 1, 2017, of course, we moved to the new limits, and there are no age discrimination. There's no age-based limits anymore. It'll be a flat $25,000 in non-concessional, in concessional contribution limits for everybody, and $25,000 will be the max. That takes into account anything that you get via the superannuation guarantee, anything you salary sacrifice or claim contributions. Claim as a tax deduction via business or something like that. The other sorts of limits, of course, are the non-concessional contributions. They are currently $180,000 for this financial year, and that drops to $100,000 for next financial year. If you're able to use the pull forward rules and you haven't tripped them in recent years, then you can potentially put in $540,000 using the 3-year pull forward by putting in $180,000 for the current financial year, FY17 plus FY18 and FY19. If you're waiting or unable to make non-concessional contributions until next year, then the limit drops to $100,000 and the 3-year pull forward falls to $300,000.
Bruce, another change is around the pension balance cap. Could you please explain that?
Yeah, look, what we're going to have from July 1 is we're going to have a cap on the amount of money that you can have in a pension fund for the first time since the limits were removed in 2007. So the most that you'll be able to have in your superannuation pension accounts now from July 1 will be $1.6 million. Essentially, the government has said that $1.6 million is as much as we believe that you should be able to have tax-free in a pension fund where the pension fund doesn't pay any tax and where you're not paying any tax on the income you derive from that pension fund. So that's essentially the $1.6 million limit, which comes into play for everybody from July 1, but for those who will be turning on a pension sometime after July 1 for the first time.
With the new restrictions coming into place, should someone borrow to get money into super?
Look, it's a question that I would normally say no to. Borrowing money to put money into superannuation doesn't normally make sense, except if the borrowing is very short term. So if you are wanting, the reason for that is because the borrowings or the interest on the borrowings is not a tax deduction. If you buy an investment property or buy shares with those borrowings, then outside of super, then it's for the purpose of deriving income, and the tax deduction on the interest flows through from that. But when you're borrowing to put money into superannuation, the interest on the borrowings is not tax deductible, so normally it doesn't make sense. However, it may make sense for some people in the current situation if they know that they'll be able to repay the money fairly quickly after the 1st of July. If you were wanting to borrow up to $540,000 or $1.08 million for a couple to be able to use those non-concessional contribution limits prior to June 30, and you happen to know that you're selling an investment property which will free up the money to pay back that debt in the first financial year afterwards, then it may make sense to be able to get the extra money into superannuation. The last time this was a big issue, of course, was in the lead up to June 30, 2007, when we had the $1 million limit. The big difference then was that interest rates were 7 to 8%, whereas nowadays they're around the 4.5% mark for most people. So it can make a little more sense to do it in today's atmosphere and what's going on in the lead up to June 30. But again, really only if you believe that you're going to be able to repay the money fairly quickly after July 1.
Bruce, for someone who's got a transition to retirement pension, what are the changes that will affect them?
Well, this is going to be the first time in superannuation history in Australia where a pension fund has been taxed. So if you have turned on a transition to retirement pension where you're accessing between 4 and 10% of your superannuation pension fund as an income stream, the pension fund itself is going to be taxed for the first time in the same way that a normal superannuation accumulation account is being taxed. So if you were to have, say, $500,000 in a pension fund, in a TTR pension fund, then that will be taxed at 15% on the income or effectively 10% on the capital gains after the 1/3 discount for capital gains. So this will be the first time that TTR pensions are being taxed. One of the strategies in the past that didn't mean as much as it will from July 1 onwards is that for those who are over 60, if you're over 65, you've met a condition of release, and a TTR pension will turn automatically into an account-based pension, which isn't taxed. But for those who meet another condition of release, which is after age 60, ceasing an employment arrangement, changing jobs, then you can turn your TTR pension at that point into an account-based pension. This will become a very important strategy because of the tax that is going to be levied on TTR pensions. So if you find yourself in that position, age 61, 62, 63, and you've changed jobs to move from one job to another, or sold your business or something, and you're now no longer working or going to go back in the paid workforce, but you've changed that arrangement, make sure you speak to your advisor or your accountant about making sure that the TTR pension becomes an ABP or an account-based pension.
For someone who has more than 1.6 million, does it make sense to have some of that outside of superannuation?
Yes, it can, and yes, it will for a lot of people. I've talked in the past in some of my columns about the 3 pots strategy. The first pot, of course, is your $1.6 million pension fund, which will be tax-free. The second pot is the one that sits outside of super. Now, it depends on what you're earning in that fund, but somewhere potentially between $500,000 and $800,000 or $1 million worth of assets outside of super per person. This is because of the tax-free threshold that you get in your personal name outside of super. That limit sits at $18,200. It's about $20,500, including the low income tax offset. But it actually comes a bit higher for people who are over 65 or of pension age, where they can earn as a couple $29,000 each roughly, or as a single $32,000, $33,000. So if you're earning up to those amounts of money outside of super, then you'll pay 0% tax on that money. The reason to have the 1.6 million in super and then potentially this $500,000 or $1 million of assets outside of super is that if managed properly, neither of those two asset pools are going to pay any income tax. Potentially outside of super, if you're selling an asset, creating a capital gain, that it may push you over the threshold. The third pot is the one that you're coming back inside super and in accumulation for. And in accumulation phase, superannuation will obviously be taxed at 15% for income and effectively 10% for capital gains.
For someone who's on a defined benefit scheme, does that count towards the 1.6 million cap?
Yes, look, it does. And what the government has decided is that because some of the old DB funds or defined benefit funds were so generous, that there's a limit to how much of that defined benefit fund you can continue to receive tax-free. Essentially what they're going to do is multiply that DB pension income stream by 16, and that amount will then count towards your transfer balance cap of $1.6 million. So if you're receiving a DB pension of $100,000, you multiply that by 16, you get $1.6 million, and that is your $1.6 million. If you then have extra money sitting in a super fund elsewhere, then that money will have to be rolled back to accumulation or out of super. More commonly, I guess, you've got $30,000 or $50,000 or $70,000 income stream coming from the defined benefit fund. Let's call it $50,000 a year. That 50 multiplied by 16 is $800,000. That $800,000 counts towards your $1.6 million pension fund cap. and you will be able to have another $800,000 in a pension fund somewhere else. So multiply your DB fund pension income stream by 16, and that is the amount that will count towards your $1.6 million cap.
For someone who has 1.6 million already and is able to invest well with that money and grow it to, say, let's say 1.8 million, do they have to roll that money back into accumulation phase?
No, they don't. So if you become very good at investing, at taking the minimum pension amounts, but if you any way that you can make your money in pension phase grow, you don't have to pay tax on the amount. You could literally double it or triple it with some very good investments from 1.6 to 3.2 or 4.8 million or something like that. If you start with the 1.6 million, then the pension fund itself will remain tax-free, and you don't have to roll any of it back to super, no matter how much it grows. You do have to take your pension from it, so obviously you're going to have to, if you're over 65, you'll be taking 5% or more of the pension fund, which will be a bit of a headwind for growing your fund. But certainly, if you're a very good investor or happen to make a couple of wonderful investments, then you don't have to roll it back to get back under the 1.6. It's your good fortune and your good investing that's got you there.
For a couple who have uneven super balances, what's the best strategy for them before June 30?
Preferably, the situation you don't want to get to is having one member with a $3 million balance and another member with a $200,000 balance. They've got 3.2 million together, which averages at 1.6, but that's not the way that it's going to be seen. There are potentially ways of, depending on individual circumstances, of getting some money out from the pension fund, from the larger pension fund or larger superannuation balance, and getting into the balance of the lower superannuation balance member. This might be through making non-concessional contributions or taking a drawdown from the larger pension, and if the lower balance member is able to make contributions to super, being under 65 and still working or meeting work tests, then you may be able to get some money back into that account to hopefully at least even it up a little bit, if not quite a lot. It depends on everybody's individual situation as to what's going to work best for them. But whatever you can do to try to even up those balances a little bit, to get somebody back under 1.6 million and get somebody who's quite low in their superannuation balance to get them up higher as members of a couple, will be enormously beneficial because of the tax reduction that you'll pay overall on your funds and investments that are sitting inside super, inside pension and inside the super account.
Bruce, thanks very much for answering those questions. I'm Tony Kay, I'm the editor of Eureka Report.